I've gotten questions about all-time highs since we started hitting them again in 2013, and I started writing my blog. We got a ton of good charts here from Exhibit A, so why don't we go through them? First one, number of new all-time highs for the S&P 500 by year going back to 1990. There could be times where you go through a very big dry spell. Now, this was the lost decade, so you had a handful of new all-time highs in 2007 after having none from 2001 to 2006, and then you didn't have another one until 2013. And now you've had a ton of them, and you had 2023, none, a bunch last year, and then a handful this year. So these things do tend to cluster, so just because you've had one doesn't mean that they're going to all go away completely. But the hard part about this whole discussion is the fact that one of these new all-time highs is going to be like the one, right? Where you fall off a cliff. We just don't know what it's going to be. This is a different way to look at this. So you can see all the dots on the chart there. This is just a prettier visualization that just shows like how much these cluster, but also like how many there are when you hit a bull market. There's a ton of them. So if you think like, okay, this is the one, good luck guessing which one it really is. And finally, this is one of my favorite ones. Investing at all-time highs is actually better for average returns than investing on all of the days. So this is looking out 1, 3, and 5 years from the day you invest. If you invest at S&P 500 all-time highs, it's actually higher returns going out 1, 3, and 5 years, which is very counterintuitive if you've never seen this data before. It's like, wait a minute, that makes no sense. Wouldn't it make more sense if you invested from lower value? But this is a momentum sort of bull market. One of the things we've learned for the past 7, 10, 12, 15 years, no one can predict when this stuff is going to come to an end. If you say, well, great, I would really regret it if I put this whole 400K into the stock market and fell out of bed tomorrow. And we had even a 10% correction. That's 40 grand down the tubes, right? Sure, I can wait, but I don't want to. If it's going to make you feel better, then slowly but surely dollar cost average in, or make it a more balanced portfolio, have some sort of hedge there. I do think when you have a big lump sum pile of cash, you know that the numbers say just put it into the market. 3 out of every 4 years, the stock market goes up. That's really good probabilities, right? You're not going to get anything like that close to at a casino or DraftKings or something, right? It's not gambling like that. But the regret if you're wrong is probably greater. So if you want to just leg back into the market and dollar cost average in over a certain period of time, pick a period of time, pick a cadence, just put it in, set it, forget it. We go down 20%, you want to add a little more? Sure. Just because the market's at all-time highs does not mean that you should be scared or nervous. It's actually historically a relatively good thing for the stock market.